Fergus, thanks for joining our podcast. Really appreciate it. Dano and I look forward to having this conversation. Before we deep dive into, asking some of these questions, tell us briefly about your background and how your prior experience has helped position you to become the general manager of NiCo, and why NiCo.
No worries. Well, Dano and Rad, thank you very much for the invitation to join your illustrious show. I can say this is certainly the pinnacle of my media career thus far. So no, I appreciate the call out, gents, and looking forward to a good conversation. So a bit about myself. So I am from Adelaide originally, so I'm not necessarily a West Australian, but yeah, from Adelaide originally, but living in Perth. I'm a geologist by trade. And I've been working in the mining or exploration sort of space for maybe 13 or 14 years, something like that now. I've been lucky enough to have quite a varied career, sort of working right across the development cycle from greenfields exploration through development, studies, construction, and into operation, sort of open pit and underground. I've been fortuitous, although through no large design, to have exposure to an alternative amount of commodities as well. So I guess I wasn't necessarily, I'm not, my experience is not just in gold or just in iron ore or just in coal or something like that. So coming from South Australia, we've got a large sort of copper endowment. So I started my career prior to that, I started my career working for Newmont in the Tanami Desert as an undergraduate geologist while I was studying my degree. So I was up in the Tanami at the granite site for sort of each summer and each winter throughout my university career. And then following completion of my uni career, I started working for a junior development exploration company out of South Australia called Havilah Resources. So we were exploring for and delineating a very large copper gold project called Kalkaroo in the Curnamona province. We built a small gold mine called Portia, and there was also some iron ore and gold exploration as well. That took me through to about 2014, and then there was not a lot of work in the mining industry. Most of the commodity prices had fallen out of bed and there wasn't a huge amount of work. So I decided to take off and go traveling. I needed a change from an experience perspective, but there was nothing out there. So I decided to go traveling. And so I jet set it off to Europe and backpacked my way around Europe for a couple of months. And lo and behold, I absolutely enjoyed that. And so I decided to set up in London for a little bit. And so then I needed to find, I guess, enough work to support that lifestyle other than pouring beers and moving boxes for a removal company. So for a few years, sort of end of 15 and 16, I was lucky enough to do some greenfields exploration throughout the Balkan Peninsula in Bulgaria and Serbia, Armenia, and Georgia. And it was while I was over there that I started to do my first sort of, mining deals. I tried to put together a few mining deals in Georgia, and Armenia, actually. I've got some interesting stories there, but maybe they're for another date. Lo and behold, it didn't quite work out. There was a fair amount of counterparty risk in those countries. And so I found my way back to Australia, started working in the Pilbara for a gold mining company called Millennium Minerals. And following that, I spent almost 4 years working for private equity investment vehicle called Wyloo Metals. My time at Wyloo Metals had a large amount of exposure to looking for the battery metals, and it was through that role, working in the BD team, supported by an exceptional group of people there. That is a seriously smart organization, Wyloo Metals, headed up by Luca. That company, I spent a lot of time doing sort of global asset identification, particularly in the nickel space. And it was during my time there that I sort of took a deep dive into the lithium-ion battery and tried to understand why it was that these raw commodities were required in the battery and how they fit into the battery and what you sort of needed. And lo and behold, it became pretty apparent that you didn't need nickel concentrate at 11% nickel or what have you. What you needed was a metallogenic assemblage of nickel, cobalt, and manganese at 99.99% purity in a hydroxide form. And that's what ultimately came out of these cathode or precursor refineries. So that then sort of tweaked something in my brain where I thought to myself that if we're going to need a long supply or the amount of nickel requirement that was coming down the pipeline, which is sort of a tidal wave of demand, probably lent itself more to mines that could scale up production fast. And therefore, I sort of thought that looking at underground nickel sulfide ore bodies, albeit can be extremely high grade, you're essentially volumetrically constrained by a 4.5 by 4.5 meter hole in the ground. So the amount of metal that you can extract out of that ore body is constrained by your decline. That's if you have an ore body, or perhaps you could put a shaft in, but there aren't too many underground sulfide ore bodies that have a plus 10-year mine life that sort of can amortize the cost of sinking a shaft. So I started to think that the laterites were going to have to take the lion's share from a demand supply gap perspective. And then once you start to look at a laterite, you start to understand that within the ore body itself, there exists nickel, there exists cobalt, and there also exists manganese. Also, there's some aluminium, some iron, some other metals in there. And like I touched on earlier, the lithium-ion battery, which is sort of the value driver for this sort of next nickel commodity market, it's not just nickel that this battery needs. It needs a metallogenic assemblage of nickel, cobalt, and manganese. So then when you start to put the entire value chain together, you start to ask yourself, if you're a lithium-ion battery producer sitting in South Korea or in Japan or in Europe, does it make sense to secure your raw materials, say nickel from Russia, cobalt from the DRC, and manganese from South Africa? Or would it be better to have one counterparty that exists in Western Australia, the best mining jurisdiction in the world, where you have security over your asset, knowing the next day when you wake up, you're going to own your project, and you can import all of the raw materials in a mixed hydroxide precipitant, which is the preferred offtake option for these batteries. And so that's how I found my way to identify the Wingalina project as possibly the most valuable nickel project on the planet. And then when you overlay the fact that the project has already received EPA approval and construction for mining and has a traditional owner access and mining agreement, which has become particularly difficult to negotiate since the 2020 Jerk and Gorge incident, you start to understand that you're sitting on a world-class ore body that is the third largest undeveloped reserve globally that contains all three of the metals that go into the NMC cathode side of a NMC battery, and you have the mining agreements in place and environmental approvals in place to build that operation. You just simply need to finalize engineering and obviously raise a significant amount of capital to do so. And so that is, I guess, the culmination of a bit of my history and why NiCo Resources and how I ended up working for NiCo Resources, or identifying that particular asset as possibly the best asset in the world to be associated with in the next 5 years.
Thanks, mate. That's a really very interesting background that you've sort of presented to us, and tied it nicely into how the opportunity for NiCo has come up. So I sort of want to continue on the more recent trend in your discussion around nickel and its role in the battery, and and tie that into the project's history, because it has been around for a long time. So is it really the battery revolution that's making it the right time for NiCo at the moment? Is that the key shift in what's happened from a macroeconomic perspective that you believe makes it the right time to attract investment for the project?
Oh, I don't think it's necessarily as granular as that, Danu. I think realistically what you have is you've got a structural change in the demand side of the equation. You know, any commodity market, as you well know, is just the supply and demand thematic, right? So what you have new entrants into the market, being, I guess, the lithium-ion battery space, predicated on, I guess, decarbonisation of the mobile fleet, the global mobile fleet, which of course will merge into fixed and stationary energy storage as well. So you've got a structural change in demand for some of these commodities around the world. And then all that really is doing is outstripping the current supply, which is seen underinvestment over the last decade anyway, since the Chinese driven commodity cycle that we went through in the early sort of 2000s up to sort of 2010 and 12. So, I mean, to round back to your question, absolutely, the incumbent in the market is the lithium-ion battery producers looking to secure more supply. And what that's doing is that's pulling nickel units out of the stainless steel supply chain, right? Which still accounts for 80 to 85% of the global market share today. But as that battery penetration or EV penetration starts to increase over the next, the numbers are like 27% CAGR over the next 5 years. You know, like that is ridiculous growth. So, and that number is, you know, we can debate whether that's true or not, but the amount of demand projected for 2030, for instance, is such that price is pushing higher to incentivize new supply to come on. So I would say that the Wingalina project itself is one of those assets that exists. It's a world-class project that's been known about for quite some time, right? But logistically, it's been constrained via its location. And I guess for those listening at home, the location of the project is pretty much at the triple junction point between the Northern Territorian border, the South Australian border, and the West Australian border, which is a place called Surveyor General's Corner. Where it is, it's extremely isolated. So you need a pricing environment high enough to sustain the capital cost to build the operation. Because it's a nickel laterite project, the operational cost leveled across a large production profile should put you in the lowest half of the cost curve, right? But the cost to sit in the lowest half of the cost curve is a large capital cost. And so you haven't really been able to incentivize CapEx builds for any of these commodities, large commodity projects, until you've seen the implications that are coming from the increased demand from, I guess, what is this global decarbonisation effort or the energy transition. So does that kind of answer your question? It's probably a little bit more macroscopic as opposed to Wingalina. I mean, I can talk more about Wingalina, but that's kind of how I think about the commodity markets in general, right?
No, I think that's a great answer, and I think you've touched on some of the other things that I had on my mind, which is, you know, what is the long-term incentive price that you need to bring on new supply? You know, this is a big project. As you said, it comes with the capital, but you need a sustained price environment over many years to recover that capital, right? So what is the incentive price from your view? Is it right at the moment? Or does it need to be even higher? Will it go higher? What do you think?
No, look, I think if you bring up a price chart, if you bring up an LME price chart of nickel over the past and track it all the way back to the 80s when it started, what you'll see, or the 70s, I think it is anyway, somewhere in there, you'll see three succinct, well, you'll see two pricing environments, and then you might see the introduction of the third. Effectively, if you go right the way back to the 60s till when the Kambalda and the Widgie Dome were found in Western Australia, and sort of you had the first great nickel rush predicated on the development of stainless steel coming out of the back of World War II, right? Nickel shot from being effectively like less than $1 a pound up to sort of $1.50 to $2 a pound. And it sort of sat in that sustained period from most of the 60s until you had structural oversupply and the market crashed, and then it fluctuated, right? And then you get up to the 90s, and then you have an increased demand, which was the Asian markets were growing again, right? So before the Asian before the Asian currency crisis, which occurred in the 90s, and you had another pricing environment. And then if you go to the look at the price between 2002 to 2011, where the last price crash was, you see that sustained, you see the upward trajectory, but the price doesn't really drop below sort of $4.50 a pound until it peaks at 50,000 and then crashes again, right? And so all of those environments, you can then go and map to periods in history where you've seen increased demand in that particular commodity, being nickel, right? And it is preceded, or the preceding time period has resulted in structural underinvestment in those commodities. And that's why nickel is so volatile. I think what you're seeing is that you're seeing that right now again, except the sustained price of 20,000, which we've held since the LME price scare that occurred in March this year, seems to be the new floor price. We were on a sort of upward trajectory from 14,000 bucks a ton in 2018, 19 period, to sort of now sitting and holding and maintaining that $20,000 a ton. I don't know if that's the sustained price going forward, but it does seem that we've now put together sort of month on month and almost quarter on quarter price sustainability above that 20,000. So maybe that $20,000 is the new floor price in this pricing cycle. Time will tell. What does that mean for NiCo Resources? Well, I can tell you that if you go look at the Wingalina project and the pre-feasibility study that was completed by the previous steward of the project, Metals X, between 2008 and 2012, that was during that pricing cycle when the nickel demand was exacerbated by that Chinese commodity cycle and Chinese demand for stainless steel. And at that time, they were using $20,000 US a ton to model their nickel price, and $45,000 a ton US for cobalt. We're not in a too dissimilar pricing environment right now, right? And if you go back and look at that study showed an extremely profitable operation. Yes, it had an extremely large capital cost. The capital cost back then was $2.2 billion Australian, but it did produce a project that had a all-in sustaining cost per pound of nickel of $4 US, including your cobalt credits, right? And you're able to produce 40,000 tons of nickel and 3,000 tons of cobalt for 42 years. And so that's what I was trying to discuss in the answer to the previous question is at periods in time in the market in sort of every 10 or 20 years, you have the capital markets open up to incentivize development of these large scale infrastructure projects, whether they're natural resource projects, whether they're big infrastructure builds, and they are the types of environment that drive investment into the underlying raw commodities. And I just simply believe that we're in that pricing environment now. And if we've sustained plus $20,000 US a ton nickel, and the project when it was last modeled using $20,000 a ton nickel, yes, we're going to see inflation on the CapEx side in the study that we're currently working on, but the pricing environment's not too dissimilar to what it was back then. And it showed a highly profitable operation. So, I'm pretty comfortable with where the nickel price is at the moment.
No, that's good that you've compared that to the previous study. I think that's a good baseline. So then is there any threats though to the nickel demand? So, other battery chemistries that, that don't include nickel, such as LFP, I mean, they seem to be getting a bit, more wider, I guess, use in everyday sort of consumption. So do you see that as being a threat at all to the demand profile that you're talking about?
No, personally, I don't. And I actually think that anyone that is telling you that nickel-based chemistries are going to dominate the lithium-ion battery market, or at least the EV market, are probably talking their own book more than talking sort of statistical-based evidence. If you think about the development of any new technology, right, you have 3 points in a technology's lifespan that incentivize, I guess, breakthrough and then mass adoption. So the first point in the lifespan is when you have the technological discovery, right? Lithium-ion batteries technological discovery was in 1980 when I forget the gentleman's name, Japanese gentleman anyway, took ExxonMobil's study data from the 70s when they were worried about peak oil and put lithium together to create the lithium-ion battery. Now that technology sat on the shelf for many, many years, basically accruing dust until Panasonic bought the patent and put it into utilizing batteries for mobile phones, right, in the mid 2000s. Okay, so then after they put it into small scale electronics and that sort of developed the market, that was the second point in time. Now the third point in time is mass scale adoption, right? And mass scale adoption is where you have cost competitiveness of the incoming technology surpassing whatever the outbound technology is. If we're talking about electric vehicles, to secure mass adoption, right, we need electric vehicles that can be priced at sub $40,000 US a ton, right? $40,000 US a ton, $40,000 US per unit sold, okay? Right? Now, you tell me, Danu, you're a pretty smart and intelligent fella, and you too, Rads. Do you think, right, if you're looking to secure mass adoption, you're looking for uptake from the lower to medium class incumbents in the market, right? Do you think that they're going to go out if you're on an annual wage of between $60,000 and $80,000, which is the medium term wage for depending on what country you're in, right? If you've got $60,000 to $80,000 as your annual wage, are you going to go out and spend $120,000 on a Tesla Model Y or a Chevy E truck or something like that? You know, does that pricing environment incentivize mass adoption for this technology? I don't think so, right?
Yeah.
And everyone knows, right, if you are reviewing the cost breakdown of what an electric vehicle is, depending on commodity prices, it's pretty extreme now. But if you go back and look from 2017 till 2021, you'll see that approximately 64% of the EV is in the lithium-ion battery itself. And then within that cost point, you also know that it's 54 or 56% of that cost is within the cathode itself. Now, if you can substitute nickel and cobalt out of that cost profile and replace it for lithium and iron phosphate, right, you significantly reduce the overall cost of the car, right? Which now then starts to bring you below what you're trying to seek, or what mass market adoption, I guess, is trying to seek, which is that sub $100 per kilowatt hour threshold. There is absolutely no way that we will achieve mass market adoption with NMC chemistry. It will be predicated on LFP, and that is completely fine, right? Because the reason why nickel is so important is where it sits on the periodic table. The reason why I personally have backed nickel, right, as the commodity of choice to go after, is that where nickel sits on the periodic table, it sits at the point where it has the largest amount of chargeability, so it can generate the largest current for the lightest weight, elemental weight, which means that for anything to usurp nickel, right, as the highest power density metal that can go on the cathode side, we would, as a civilization, literally need to invent a new metal or find some supply of some metal, all right, some elements, right, that we've never discovered before. And let's remember that the periodic table hasn't changed since about the 1600s. So I would say that whilst mathematically it's possible, there's a very small chance that we're going to discover a metal that has a higher power density than nickel. Lithium is the other element that is going to exist in all of these, in all of the mobile storage, because it's the lightest element that you can pass charge through. Okay, so they're the two elements that have a physical characteristic, which means that they are highly unlikely to be thrifted out of the total chemistry. So instead of targeting, say, 50 to 60% of the market, which would be mass market adoption in the lowest value, in the lowest economic value vehicles out there, I've turned around and gone, no, I would rather target the 38%, which is commercial commercial mobile fleet, right? Whereby the thing that is important is the total amount of distance one can travel on a charge or a tank of fuel, and the recharge time or refuel time. Because if you're not on the road driving, right, then you're not making money. And secondly, the entrance into that market are businesses that are able to amortize a higher cost, right? So instead of targeting a larger market with a smaller individual pool of capital, I've made the bet on the physical characteristics of the metal that are going to supply the one part of the market where it will be highly unlikely for it to be usurped. And that's why I'm more than comfortable staying in nickel, but totally believe that LFP or LFMP or another variant that may be even cheaper and more cost competitive than LFP could enter in the market. And I don't want to gamble on that. So I'd rather gamble on physics instead.
Yeah, no, that's great perspective on the dynamics. And I think, in terms of that sort of commercial application and the barriers to entry for that, you're right. The nickel is irreplaceable, and therefore there is going to be a demand that won't go away. So I definitely share that sentiment. So I think it's a really good explanation. Maybe over to you, Rads.
Yeah, so Fergus, tell us a bit about the strategic significance of the Wingalina asset, and who are the likely customers of NiCo's products in the future?
Sure. Well, I guess as I touched on earlier on in the chat, I'm a geologist by trade, although I'm a pretty average one, as I was telling you guys offline. But one thing I do know, as I said, is the lithium-ion battery is not it's not just nickel that's required. It's nickel, cobalt, and manganese. And so I am of the pretty firm opinion that having I guess exposure to a nickel laterite system that contains nickel, cobalt, and manganese within the ore body is highly strategic. I also believe that having ability or having exposure to an operation that can scale up through open pit mining as opposed to underground mining will become important, because I believe the volume of metal that's required to supply the demand supply gap is going to be much greater than maybe not now, but certainly a few years ago that most people were anticipating. And so being a geologist, I start with the rocks, always have done. And if you just park the fact that Wingalina is a nickel laterite, and don't get me wrong, nickel laterites have a very checkered history, both in Australia and more broadly the Western investment community. If you just compare Wingalina on a pound for pound basis against other laterites around the world, it stacks up as a world-class asset on tons, grade, and just about any other classification characteristic you would like to look at it. Now, the location in the world, if you look at the geographical distribution of nickel around the world and where it forms and lies, what you'll quickly discover is that sort of close to 90% of the global resource and reserves are located within 7 countries. So looking at the reserves distribution globally, you'll see that Indonesia has the largest reserves of nickel, followed by Russia, followed by the Philippines, followed by New Caledonia, followed by Australia, then New Cal, then Brazil, and then China. If you go through that distribution of countries with a Western investment lens, right, you'll quickly discover that, say, Australia or Canada, I didn't mention Canada's sort of 8th or 9th, but Australia and Canada are the likely 2 investment jurisdictions, and maybe Brazil as well, depending on your risk appetite. So even if you perform a critical assessment of the global market, it's very difficult to get exposure outside of those countries. And then speaking specifically to laterites, the best laterites in the world occur in what's called the Coral Triangle, which is effectively Southeast Asia, and that sort of exists between New Caledonia through New Guinea up to Indonesia, up to the Philippines and down. Now, there are absolutely some monster deposits in there. And a lot of them are accounted for on just a reserves basis, but have some exceptional reserves and resources. We're sort of talking plus 1.5% nickel for 400 or 500 million tons, like the best deposits in the world. But Wingalina still stacks up in the top. I think it's 11 or 12 on a global basis when you're looking at tons and grade. But you show me a project in Indonesia that you can get exposure to, that you can assure me you'll still own in a year or two's time. So yeah, when you start to apply those lenses to it, I think what you start to see is that Wingalina starts to float to the top as a highly sort of strategic asset on the global scale. And you got to remember, at the end of the day, the explorationist in me is forever going to be out looking for new deposits, right? But everyone who's assessing the market today is effectively got to draw a line in the sand and go, right, if we don't find another project, between now and forever, where are the reserves and resources in the world, and how are we going to get exposure to them? And so, if you're looking in the rear vision mirror as opposed to out the front windshield, if we keep the car analogies going, I think having exposure to certainly the largest undeveloped nickel project in Australia and the third largest undeveloped nickel reserve globally is probably a pretty good asset to be associated with, despite its location. So
what about then, I guess, HPAL projects have had a bit of a checkered history. You did sort of touch on that. So, in terms of attracting that investment, overcoming that perception and those fears for potential investors, what is NiCo doing? What are you leveraging off? That's all, obviously there's a humongous amount of body of work that exists. What are you leveraging off? What are you looking at doing differently? And what are you doing to sort of tighten the parameters to increase the confidence of the studies and the development?
Sure. So it's a good question, actually, Dano, and one I'd be happy to give you an answer to. If I just start with the asset, I touched on earlier that the project was sort of worked up to a pre-feasibility stage when it was in the Metals X stable. And throughout their tenure with the project, they spent sort of circa $75 million on the asset. Now that brought the asset through to a 200 million ton reserve with a resource with a 93% conversion to reserve of 168 million tons. So you've got that's where the 42-year life of mine comes from. So significant reserve, check. You've got permitting in place from the Environmental Protection Authority, check. You have a mining agreement in place with the traditional owners, check, right? So we, as NiCo Resources, certainly the idea was, and interestingly, when you think about the Wingalina project, like I've touched on, certainly from a geological perspective, it's a world-class project on a tons and grade perspective. Yet it's never sat in its own vehicle. It's never sat in a vehicle where it's been able to shine, where it's had a dedicated management team, access to capital, and a development strategy that is focused solely around the development of that asset. And so learning from projects that had a bit of a checkered history in Australia, and then looking at projects that have been developed in the last decade, particularly in the last 5 to 7 years, which have been delivered on budget, at cost, and ramped up within timeframes. So to highlight a couple of projects around the world, well, first of all, if we start with the Australian landscape, it's many people in the investment community, and I face this criticism regularly, look at Murrin, look at Ravensthorpe, look at Goro, as examples of projects that were significant destructors of capital and time and budget, and there's no doubt about that. But all of those projects now, today, except for Goro, obviously, are sort of either ramping up or have ramped up, or in the case of Murrin, one of the highest contributors to profitability for Glencore's balance sheet. So even the HPAL 1.0 projects eventually came good. Now, I'm not saying that's where we're at. We're sort of at, I guess, HPAL version 4.0, if you will. And if you look at the if you look at a separation between investment communities between the West and the East, with a particular focus on the Philippines and Indonesia, you start to look for and see examples where either Chinese-driven investment and operation has developed projects like Ramu in New Guinea, or the Mogwali Industrial Park, which has just had 2 high-pressure acid leach circuits turn on in the last year by Huayu Cobalt. Or you can go and look at Sumitomo's Coral Bay in the Philippines. All of these operations are examples of operations that have been delivered on time, on budget, and had faster than expected ramp-ups. And some of the learnings that have come out of those development stories are such that the HPower 1.0 projects were built too big. They were too big, and there was too much reliance on a single train or a double train. Without getting, I guess, too technical and having the 2 of you inspect the back of your eyelids on this call, the high pressure acid leach circuit has a pinch point within the flow sheet, and that is the autoclave. And if the autoclave goes down because the chemistry isn't managed right through the flow sheet, not only are you missing production, right, but if you have an acid plant producing power, then your power cost is going through the roof because you're not having that power associated. That downtime takes a couple of days to clean. Every year, an autoclave goes down for 1 month in a year for cleaning as you take the autoclave offline every quarter to descale it anyway. And so what was happening was the efficiency rates of all these operations just weren't running at capacity. So you had these HPower 1.0 projects that were running at 50, 60% efficiency, right? And you just weren't paying back billions of dollars in capex, and that's where everyone ran into trouble. I guess the HPower 2.0 and 3.0 versions, where we're sort of sitting at now, have de-risked the flow sheet by adding multiple trains of high pressure acid leach circuits. So what you've done is you've eaten a higher capex at the front end, but you've de-risked your production profile and allowed at least a little bit of flexibility within your process flow sheet, such that if you don't manage your chemistry correctly through the autoclave, or you scale up, or there's something unexpected happens, you don't lose 50 or 100% of your production capabilities in one hit. You may still be able to take one offline and keep, 66% if you had 3 or 75 or etc. So I guess from NiCo Resources perspective, and this is a very long-winded way of saying that, it would be my intention to take the company through development of this project and subsequent studies to incorporate many of the lessons of the past that others have spent billions of dollars learning, and leverage that into I guess a project design that can be as de-risked as possible, whilst also completely acknowledging that a high pressure acid leach sits on, I guess, the highest point of the execution risk profile. So that would be speaking to the other assets. And then the final point that I would touch on, I guess, is to do with the Wingalina geology itself. So I guess the throughput or the process material that goes through a high pressure acid leach was designed to process what they call limonite ore. And again, in fear of making sure that you two aren't falling asleep in your chair, limonite ore, if you think of the geological profile, you have sort of cover, then you have limonite, then you have saprolite, and then you have fresh rock. Now, the nickel grade goes up as you go into saprolite. So you go from, 1% nickel maybe to 1.5%, 2% nickel in saprolite, but the iron grade drops down. You go from, 30 to 50% back down to 20%. Also, the magnesium grade goes up as you go into saprolite as well. So one of the main things, which is managing the chemistry, is and managing, I guess, a lot of the operations that went with a blending strategy, which was trying to scavenge nickel units out of the higher grade saprolite, were then not putting enough iron bearing material through the high pressure acid leach, and that was stopping the reaction and calcining up the autoclaves. Our operation, the Wingalina ore body, we've got 168 million ton reserve. Less than 8% of that entire reserve number is attributable to saprolitic ore. We are only going to process limonitic ore, and that's the intention of what a high pressure acid leach circuit was designed to do. So I guess there are inherent geological characteristics that help to de-risk what is an exceptionally difficult process flow to begin with. But that's another reason why this ore body is so special and so unique. There really is only one other geological analog in the world that is comparable to our ore body, and that would be the Ambatavi project in Madagascar.
So describe the composition of the NiCo share registry. Who is your investors? Do you see a lot of institutional investors jumping on board, or is there strategic partners investing in the company, or do you see a lot of retail investors also investing in NiCo?
Yeah, it's a good question, Rad. So we are a very new company in the sense that we only IPO'd on the 19th of January this year, 2022. So we've only ever done, I guess, one capital raise, and that was the initial public offering. If you look at our share structure, what you'll see is we have two, I guess, major shareholders or cornerstone investors. Well, in fact, actually, we have three now. During the IPO, we had Metals X, who was the previous owner of the project. They wanted to retain exposure to the asset. They knew, just as we did, that it's a world-class project, but they just didn't have dedicated management time or strategy. So their retained exposure is by way of equity into the NiCo Headco vehicle. We also have a very supportive and strategic shareholder in a fellow ASX development company called Blackstone Minerals here in Australia with the Ta Qua nickel project in Vietnam. So they also took circa 15% of the float in our IPO as well. And then you'll see our second largest shareholder is in fact our managing director, Rod Core, who has gone and purchased a significant amount of shares on market to sit at circa 16.5% of the float today. Because we did the IPO in January and we raised sort of $12 million from the IPO, if you look at our top 20 shareholders is 50, sorry, our top 20 shareholders is about 74% of the register, and our top 50 shareholders is about 82% of the register. Our entire register was effectively put to close friends and family and higher net worths around Perth because of the network that both Rod, a managing director, and Warren Hallam, our non-executive chair, brought onto the register. So that's the composition of our company at the moment from the shareholder registry perspective, and we will look to morph that as and when required in line with project funding requirements.
Fantastic. And can you also talk us through the management team as well and the experience that they bring?
Yep, certainly. So I guess if we start with Warren Hallam, who's our non-executive chairman. Warren was, in fact, the managing director of Metals X during Metals X's tenure with the Wingalina project. So Warren, by trade, is a metallurgist. Comes from working for Western Mining for many years prior to stepping into Metals X. His experience has been instrumental in bringing the fast tracking sort of our development through the pre-feasibility study. So his project exposure and knowledge has been critical for our development as a business thus far. And then stepping down to Rod Core. Rod is a merchant banker and stockbroker background by trade. He spent many years working in London for companies such as Merrill Lynch, in the finance sector. And then after Rod, there's myself, general manager. So you already got my history at the top of the call, so yes. I'm not going to bore you with that. And then we're sort of hiring out additional management staff now to take the project through completion of the pre-feasibility and onwards to a definitive feasibility study next year.
You got a strong management team. That's fantastic. And I know NiCo is well funded today. So can you please give investors some insight as how that money is going to be spent in the next, say, 12 to 18 months?
Yeah, so we, as I said, the only fundraising that we did was the IPO. and we to date have executed on a 10,000 meter drill program and working on the pre-feasibility study. Now, I guess aspects of the project have lent themselves to reduction of capital requirements to execute on those projects. So I talk about being able to leverage the existing 23-man exploration camp that we have on site, that was obviously purchased as part of the portfolio from Metals X, which has significantly reduced our exploration and drilling costs. And then we were able to leverage a large amount of data acquisition that's already occurred across the project through various other study phases that study phases that the project's gone through. So our allocation of capital has been quite modest. We have a very low burn rate within the company at the moment. As I touched on, there's the management team is slender, and we're growing it as required. But we've got a very much a frugal mindset and making sure that we are really looking to extract maximum ROI on dollars spent. So the main sort of value drivers for the business moving forward over the next 12 months will be completion of the pre-feasibility study, which has already been paid for. We are looking to commence the definitive feasibility study in early next year. And then I guess subsequent to that, we'll be looking at additional drilling programs, looking at exploration across the belt, and any sort of other data collection aspects and work programs that are associated with that definitive feasibility study.
Fantastic. And Fergus, our last question we ask all our guests: what's one thing that excites you, and what's one thing and also that keeps you up at night?
Are we talking project related here, or?
It can be anything. It can be project, it can be mining, it can be aliens, it can be anything. What's one thing that excites you? It can be mining, it can be the project that you're doing, but what's one thing that's exciting?
Yeah. All right. I think one thing that's pretty exciting for me is that we are literally living through, as we speak today, the fourth industrial revolution, and that is predicated on shifting our global energy supply from a molecules-based to an electron-based society, right? I think that's pretty incredible. We will get to turn around at the ends of our lives and say we lived through the change in global energy mix from hydrocarbons through to renewable power in whatever shape or form that happens to be. Where we're really standing, we're standing at the precipice of change. Effectively rewind back to sort of 1888, 1890, when the first oil wells were drilled out in Mississippi, and refinery of those hydrocarbons started to happen for the development of the first automobiles. So I think that's pretty exciting. I think that's a pretty exciting place to be, and being able to contribute towards that, and develop a world-class project. And of course, all of the positives that come along with that. I mean, we haven't spoken about it on this particular call, but looking at the amount of economic uplift that we'll do for the local community, and ability to secure jobs and employment and redevelopment of the communities in the Nunadara lands is going to be exceptional. And so to have a small part to play in that really gets me excited, and that's sort of why I leap out of bed every morning to participate in this project. And it really is, I guess, my passion as well in life. Something that probably scares me is the fact that if the Coral Triangle, predominantly Indonesia here, doesn't ramp up nickel production at the required rates to meet demand over the next 5, 6, 7 years, nickel will face an existential risk as a predominant cathode chemistry type within the battery matrix. It will simply get too expensive to utilize nickel as a cathode chemistry, right? And even though nickel may have the physical properties and elemental properties that we touched on earlier in the call, if the supply is not there, when it comes to retooling these gigafactories, where they can sort of be amortized every sort of 7 to 10 years, depending on size and scale, that existential risk is something that worries me, because I might be entering the market in 2027, 2028 with nickel supply, and the demand is no longer there in the volumes that exist today. So that's probably the thing that keeps me awake at night, is making sure that I have something I have zero control over, is the delicate balance that Indonesia is going to face between increasing supply and off-takers taking that supply at what sort of environmental cost and burden, just to keep development of the market going.
Yeah, I think that's a really interesting point that you make, Fergus. And I think, if you look at the automakers and you talk about ESG and, their preferences around that, for example, they're still going to need that Indonesian supply. And
absolutely.
And I think what you're reflecting also is a general sentiment that you want everyone to succeed in the nickel industry. Really, like there's no real winners and losers. You want everyone to sort of be able to get their projects up and running to make sure that the transition actually takes place. And then there's a home for nickel going forward, right?
Absolutely, yeah. And if we don't, right, then yeah, nickel-based chemistries will die out, because simply the supply of the raw material won't be there. It'll be thrifted out, not because it's a poor chemistry choice, but because you can't have these gigafactories set up for NMC-based chemistries if there's no nickel to put through the front door.
Thanks very much, Fergus.
No worries.
Thanks for the conversation. Really appreciate it.
Anytime, gentlemen. It's been an absolute pleasure to have a chat to you this afternoon, and anytime you want to listen to me drone on about boring things like rocks and development of Australian-based nickel laterite projects, I'd be more than happy to come on and have a chat again.
We'd love to have you back. We'd love to have you back. Cheers.
Cheers. Great work, gents. I'll
Thanks.
speak to you later.